Welcome to the Macro Contrarian Tourist Hour. My name is Jack Barnes, and I'm your host. And I have with us a lineup of guests. I'd like to introduce, first of all, my co-host of this series at this time, the one, the only, Mr. Nashville with a $. Bob, are you
Thank
there?
you, Jack.
Hold on a second.
I'm here.
Let me see. Are you? Yeah, there you are. You're drinking your New York coffee, I see.
Yeah.
So as we
Lovely to be here.
Welcome. Do me a favor and tilt your camera down just a little bit. We have a. There we go. There we are. Now we got you with your mixing headset on. Very hip looking here.
Well, that's only because the kids stole the earbuds.
All right. So first question to you. We'll open it up with a quickie to you, of course. What's the most politically interesting topic you know of at this moment?
Well, we discussed this a little bit offline, but Egypt, I guess, is the critical concern, both nationally and internationally. I mean, the U.S. has sent over a new representative to Egypt, actually, as of today, an assistant secretary of state. And his name escapes me at the moment, but it's very high level nonsense, and the price has been reflected in crude. That's kind of driving the bus at this point.
We're going to be going to two of our friends who love the futures market and love the crude market, and we'll be tossing them the crude football in about 10 minutes. Before we go there, we have a new guest. He joined us last week for, I believe, 5 to 10 seconds of airtime, where he introduced his name and then the power went out. George, are you there with us?
Yes, I am. Thanks a lot for inviting me. This is George Robertson.
George, all right. George, can you're displaying a graphic for us right now. It looks like nominal potential gross domestic product. Can you give me a little quick thought on that and why you find it of interest at this time?
I think this is the heart of the storm, if you will. Really, it's the driving matter for everything that we're looking at right now for asset val. Everyone, I'm sure, who's taking a look at this right now has seen this many times. That's where potential versus actual growth had been. This is NGDP. And then we had the solvency event. And then we've carried on like this. Now, the vast majority of people, based upon their past experiences, will look at.
Go ahead, George.
We'll look at the two in terms of how the actual versus the potential trades, and it's as you can see, there's been some in our experience some large recessions. This is the Reagan era one. This is the 92, the post Milken, and also going into the mortgage debacle of 93, 94, and then we had perhaps the dot-com boom. But basically, you can see that it can be explained, and you can also have a fairly good idea of where the Fed is, where it's going to be based upon how this business cycle, has behaved. Now, right now, what people are doing is that they're trying to jam the current extraordinary situation, which is this solvency crisis, into past experiences. And that's basically come up, I think, with most people not really understanding what's at stake. With a solvency event, after the Fed has reestablished growth, this output gap, which was the driving metric, and it's often expressed in terms of employment, is the first line, is really no longer an issue now for the solvency event. what I mean by that is that this difference, this loss here, is something that the country will never regain. We've had a solvency event, and now it's all just a matter of its potential growth is aligned with the potential growth that they're using to figure out potential NGDP. Now, why is this important? Is that as people watch the potential versus the current NGDP from an output gap point of view, they have all sorts of views about what is required for unemployment, what is required by all the various metrics that they'd used in past lives when the nominal versus the potential oscillated around, within a 1.5%, 2%. But the 6-7%, since this is something that's never been caught, the growth rate of the NGDP is what matters. So this means that the Fed's actions and the Fed's monetary policy is probably greatly accelerated. In fact, I would say that the Fed is probably on par as if we were approaching this type of phase in past lives. What I'm talking about is where we're already in full recovery. Now, what this has ended up with is, I think, a great diversion between how equity is behaving versus how the risk-free rates are recording it. Now, the 10-year and the 2-year and all that is in the hurly-burly. It's spot. It's very noisy. But if you look at this, I have a graph. As above this is the back euro dollars, which is really a derived rate. Nobody's out there trading a lot of 7, 10-year forward, 3-month LIBOR contracts. But what they do is they do this in big buckets of forward interest rate swaps and other various type of trading, so that the rate ends up being derived, and therefore this rate becomes a terrific reflection of the actual expectations, whether they are realized or not by the marketplace. And you can see that based upon queuing by how we've had complete recovery by NGDP's growth, and not looking at whether it's ever going to close the output gap, the Fed has taken actions implicitly, but not really making it public, from almost May or so of last year on, with the sudden realization that, they have really started to change their tune. When the May 22nd release of the April 30th minutes came out, and of course that got noticed in the stock market, and then with the famous Bernanke's press conference in June 20th. Now, the market has taken some solace with the fact that the so-called Dudley and Mateer and various other guys came in and started to talk up the Fed. And basically nobody criticized what Bernanke said. What they criticized is how he said it. He wasn't nice. He was too blunt. There's all sorts of ways he could have spun this, but
he didn't give us enough Alan
that
Greenspan.
really was the point. Exactly. So what's happened is here we've had one of the largest divergence between two asset classes that I've ever experienced, where the S&P is carried on with full confidence that all these things like QE and the Fed monetary ease is going to be something with us for 2-3 years, while the fixed income, the risk-free market, as shown by this most sensitive part, which is this forward euro, is saying, no, the Fed's tightened. So it's not a tapering issue. It's not an issue of it's not to be 2015 and now it's 2014 plus 6 months that the Fed's going to start tightening.
It's now.
Risk-free is saying it has happened.
All right. That's a really interesting supposition, and I'm looking at the chart. Everyone's looking at the chart right now. And the jawboning at your end where you're pulling them together. What's your expectation on near-term move between these two classes?
Well, I think it's Bernanke now is going to have to be as blunt as a 2x4 across the head.
For his last 6 months, he has to make it clear.
Yeah, he has to actually make it. Look, you guys, the very bright are sort of the derived cloud chamber of particles is showing that, I have tightened. But very few people are onto this. Very few people are starting to adjust their asset liability structure to reflect possibly a 1%, 1.5% by this time next year Fed funds.
Agreed.
Most people are starting to work with the fact that we got at least another year to make hay based upon the Fed's largesse. I don't think Bernanke likes that. I think Bernanke is going to come out and he's going to have something to justify it, and that'll probably be the headline unemployment number, where he will come out and just say, "Look, I don't think you guys got the drift the first time around. I am tightening. I have tightened, and tapering is really just a solvency remedy. It's got nothing to do with the monetary policy in terms of drawing back or throttling down growth or trying to juice up growth. Tapering is just purely an accounting identity, really, given how huge the solvency event was in front of us a couple years ago.
All
now,
right.
Along with that, this is like what I think Bernanke's seeing. Everyone else, this is from the Atlanta Fed, and it's called the Human Capital Site for the Atlanta Fed. And I think it reflects well with what the Fed governor staffers and what the sort of the inside track staffers of the Fed are doing right now. Everyone is watching payroll employment, which is at 12 o'clock. And you can see we're only about halfway back to the green line, which is the norm. And if you go around the clock, all the various other things, jolts, hires, quits, unemployment, and so on, the unemployment rate, it's either like lagging terribly, like we've heard about how this is the worst recovery ever, or they're saying that we're only halfway back to norm.
Interesting.
But if you look at the cutting
health.
edge, the initial claims at about 9:30 to about 11 o'clock, that's established a full recovery.
Agreed. I was just going to comment on that.
It is these initial claims and these temporary help, which I think is what Bernanke's keyed into. And I think he's been keying into this ever since it moved. As you can see, the brown line is as long. It was a year ago. So I think the Fed has actually been either clearing the decks, getting ready, or has actually started a tightening phase. I think it actually started with September, October of last year, when they had the CES revisions for the labor numbers.
Very good, George.
Yeah.
We're going to bring in some of our panel to now comment on some of the comments you've made. First of all, coming back to my partner in semi-crime, if he'd quit eating, Mr. Chewing over there on camera. Question, Bobster, what are your thoughts? Have we reached return? Is there signs of it besides initial claims and temp help, which, by the way, comment, the number 2 largest employer in America today is a temp agency. So it kind of makes sense that one is as high as it is.
Well, indeed. I mean, I think that the frustration, the question I'd pose to George is, are we done with full employment? Is full employment like a swan song? Should the Fed only have one interest,
one mandate,
rather than rates and employment? I don't know.
I think where the answer for that is that if this was a normal monetary cycle, not monetary policy induced cycle, that most of us have experienced for our careers since I won't tell you when I started, but for quite a while. I would say that we haven't reached full employment. That the Fed is screwing up. There's all sorts of 101 reasons why we still got years to go before the Fed's going to tighten, before recovery takes place, and so on, based on our past experiences. And that's based upon our past understanding of how monetary induced cycles behave. But with a solvency event is basically your city burned down, or a big portion of your city burned down. So your business activity is now based upon what's left standing. And that part which is left standing is at full employment already.
All right. Jim.
That's fascinating.
Jim, thank you for sitting in the shadows for a few moments. We're going to be coming back to you on a bigger question, but I just wanted to bring you into the panel since you and I have discussed these topics before. What are your thoughts about the new lower run rate versus the historical run rate?
Well, I'm a little confused as to where George is saying the Fed is doing anything. the Fed hasn't changed anything. How is it that we're talking about them tightening when they're not doing anything? They're still buying basically the same amount that they've been buying over the last 18 months, and there's no. To me, I don't see any difference in what they're doing that you could say they're tightening. I mean, did I miss that? How are you defining them tightening? The chairman is barely hinting at any tightening. You have a couple of hawks, the typical laugher and the typical plosser and some of the Fed hawks talking, but they're not in any way changing anything.
Direction, volume of action, quantifiable steps that you can see in the public market. Correct. We got to give Jim a second to catch up with this as we get cycled through what we're now referring to as the campaign moment. All right, Jim. So my question to you is, they're not making quantifiable changes that you can notice, and so I guess what I'm asking is, to George, can you please quantify those actions that Jim is requesting? George?
Exactly.
Sure. If you look at this graph here, and if you start to consider not in terms of what the Fed says, but look at what they've done. Now, what we're looking at here is an extremely sensitive, if you will, sort of a seismograph of the risk-free rate. And what this is the March 2021 3-month LIBOR rate, which we assume that by the time they heal things up and banks get back on track, is pretty well the same as saying the risk-free rate in 7-8 years. Now, this rate is, again, as I state, this rate is not some rate that where a bunch of guys are trading and opining about what the Fed has done, hasn't done, or what rates. This rate is basically a derived rate. In other words, as everyone gets done with everything they're going to do in fixed income, what they're going to do, what MetLife is going to do with their bond, the 30-year, what Citibank's going to do with the 2-year. After everyone gets all finished up with all their use and abuse of the risk-free rate, this shows the reality of the expectations that are being priced into the market. In other words, that 10-year can't trade as it is for all the zillions of trades in relationship to the 2-year or even overnight Fed funds unless this rate goes to this level. So this acts like a seismograph in terms of showing the actual rubber hitting the road of Fed effect. And you can see that what we had is in June 2012, this rate was trading at 97 or 3% because it's subtracted out so that a bunch of grain traders could trade this contract once upon a time. And you can see right now, and it's actually a lot lower. It's at 95.30 or 35. It's now dropped, almost 200 basis points. That's a Fed tightening. The Fed is aware of this. The Fed watches this. The Fed watches the transition in terms of how short-term rates trade versus long rates. They are very, very concerned about how the forward rates and how the connectivity between the long and short rates trade, such that this is in tension. Now, further along with that, now actually what can I show in terms of evidence? Is having observed this, then I start trying to cast around and try to find out, where's the smoking gun? Outside of Bernanke's press conference on June 20th, the only thing I can really come up with is that the QE3, when it was announced and when it was implemented and how it's being maintained, is going at about maybe half to 2/3 the rate of QE2. He's taking what he took 3 weeks to get announced and cleared out in QE2. He's now taking 3 months. QE3 became apparent in August or so of last year, but it actually didn't start to build until November. He's definitely taking his time. I actually think QE3 was not required from the impact of the solvency event. That liquidity was starting to get reorganized, asset liability sheets were getting amended. I think QE3 was a political device, and the Fed has no problems being a political institution. It's supposed to be. It was a political device to get the Fed out of the way of the election. He just wanted to actually, the public impression that the Fed wasn't backing, Romney, the Fed wasn't backing Obama. He just wanted to get the hell out of the way. So he said, okay, there's this massive QE3, and that should solve any questions or answer any questions that you have about what the Fed stance is.
George.
Well, the election's passed, and meanwhile, behind the scenes, in terms of like how much float they're allowing, how much tightness they're allowing the repo market, how much they're, what they're actually doing in terms of like 10-year repo, use of 10-year treasuries and repo, the Fed is clearly allowing a forward 200 basis points tightening in the rate. And trust me, the Fed is aware of this.
George?
Now, the Fed, yeah, go ahead.
Thank you. And we want to come back to this. We're now 20-some minutes into the show, and so I want to go to our next guest and bring him in and introduce him. Some of you who are watching the show know him as Sell Puts. He is a regular on Twitter, and I would like to bring him into the show. You are with us live, my friend. Welcome. What? You're on mute, or I got you on mute. Give me a second. One of us needs to unmute you. I'm not sure digitally.
I think.
There you are.
There you go. Thanks for having me. Working?
Welcome to the show. Do me a favor and adjust your camera just a little bit so we can see more of your head with the angle that I'm grabbing from the screen that I'm taking it from.
There you go.
There we go. That's better. So, welcome to the show. First and foremost, we're going to cycle around to crude again. And so what I wanted to ask you, I know that you have opinions on the crude futures market. What are your thoughts right now as we enter the next week?
I think from the looks of the chart right now, it still looks strong, but I wouldn't put it past it. Wanting to get back down, test like 100 again before it moves higher. But we're in the middle of the driving season, and that last inventory we had a huge draw, which basically is what sent it up through 100 that evening. I think I was at dinner. I looked at my phone.
I remember you came back 100. And you were just like, great, do it while I'm out.
Yeah. So that was perfect timing. And right now, when it went up to 107 last Sunday and we spiked down, it seems like there's definitely people up there willing to sell it. And it's working, and even right now, it's still down. I'm kind of looking to short under 105.70, but tonight. But the thing is, there's so much geopolitical risk, like Bob was talking about Egypt. Who knows what's going to flare up? The people who trade oil with a large size always know more than we do, and it seems like we're not using too much fuel here in the U.S., but someone's using the oil, and easily, I think if we get another geopolitical risk, we could drive the price over to 110, 120, because it rose so easily over 100, whereas last year, even when it got to 100, it went straight back down. So
right. What do you think about the
go ahead.
Quick transition. What do you think about the Treasury massacre? I know neither one of us are fixed income guys. But from your view, what are your thoughts on the bloodletting that
I think
the smart kids do?
For the past year, I've been looking for bonds to come down a little bit, but not so much. I was looking for more of a rotation out of people in stagnant bonds, baby boomers, looking for some sort of a return in their retirement. Like, for instance, my parents, they've got a 401k, but they're back to where they were in like 1999. And they have a lot of bonds, but the thing is, it's like, do you really want to earn this, or do you want to get into the stock market, maybe earn 5%, 6% if you're in like large cap? So with the treasuries, I think we fell too far, too fast. It's completely stagnated the MBS market. There's like no MBS flow coming through because none of these people who are locking the rates, who are actually trading on the agency desk, know where they're going to be at. So they have these huge trades, and they have people coming to them with their regular flow who, people are afraid. They're afraid of these new rates. I mean, it's a hell of a lot more expensive to get a 30-year mortgage than it was 3 weeks ago. And that day on the 4th of July, we were getting smoked down, and then we got the non-farm payroll. That was just like, clearly someone knew, someone was positioned. But the thing is, I think the Fed could definitely not necessarily lose control, but they can organically kill whatever recovery we can surmise now with these rates moving up like this. I mean, all the people I know in the mortgage industry specifically LORs, they're just completely freaking out about their jobs. The refi market's completely crushed, especially if you got a new loan in the last 5 or 6 years. It's like there's no point to refinance anymore.
All right. So I'm getting pinged from the Hammer, who is our DC inside the Beltway. What's that word to use? He's one of those bastards that goes and writes the laws that the rest of us have to deal with. Yeah, that's it. I'm trying to get him in the room to join us on the MBS side of the conversation. He'll once we figure it out.
I'll take care of that, John.
All right, get the Hammer in the room, and he'll join us at a moment that's probably not best, but we'll just leave it at that. Jim, what are your thoughts on the movement in treasuries that we just had? Thoughts on is it a longer term move? Is it done now? Thoughts on where we go from here? Never mind. Jim's in catching the Aruba 30-second delay. He'll be back. There he is. It'll give a few seconds for him to catch up. The Aruba dance is almost done. Here he is.
The minute you call on me, I lose the connection. I'm sitting here watching the whole thing, and then as soon as you say gone. So I think you had a question about oil. I hope so, because
I'll come back to oil, but I was actually asking you, what do you think about the bloodletting in treasury markets? If you were still driving the big steering wheel, would you care about treasuries at this point, or are you still an oil guy?
I haven't cared about treasuries in so long. There hasn't been anything worth being in treasuries in so long that it almost is, it's mattress money. And it has been for so long. What's the point? Okay. I think what's happening in treasuries now, the disconnect between treasuries and equities is interesting, because they shouldn't go up at the same time, obviously. But
yeah, that one's kind of throwing all of us with a few gray hairs.
I would be buyer of treasuries at this point.
George, do you have any thoughts on in quick terms? We're doing a quick round robin here on what the treasury market's going to do post Bernanke's comments this last week.
Well, it goes, perhaps I have a different perspective on treasury rates. It's not set by demand supply. The risk-free rate is always completely frictionless in terms of like more buyers, more sellers. It's immaterial. In the immediate spot, I don't know, for a day, for 3 months, it's an administered rate. The Fed sets it. And then thereafter, it's the best laid plans of mice and men in terms of the expectations of nominal GDP. Now, if you look at the 10-year Treasury, the issue here is not that it's at got to 160, 168, and now it's back up toward 2.5, 260. The issue, the point is that the nature of how it's trading, obviously something happened in May. And it does no good, in my experience, to look at rates in terms of the eyes of it was rich as hell, and I've been waiting for 4 years for this to happen, or now it's cheap as heck and it's going to go back. The way to look at it is to try to figure out if the move is large enough to indicate that without a doubt something has happened at the Fed. And I would offer that this 10-year move is large enough to warrant that not just statement. More raise that issue, but say something happened.
All right, Jim.
How can you say that? I think it's just as much the perception. I don't think nothing has to happen if people perceive that they think something has happened. And it could be nothing, and the reaction in treasuries, it's only been a couple of weeks. I think you could be premature in assuming that the market has reacted to anything that's actually happening. It's just comments by some of the Fed people, Fed speak. Maybe it's so low for so long that there's a desperation move up in the hopes of catching a bottom, and it could peter out and be nothing.
All right.
Well, just one last add on that is first, the 10 years never moves on its own. It's linked in with a multi-trillion-dollar market, right from currency, Fed funds, right out to the bond, interest rate swaps, forward interest rate swaps, and so on. So for it to say that this is just an emotional or a crowd reaction it's not in touch with the size of the market, and it's not in touch with the ability and the power and the capability of the Fed. in my experience, this type of move in the 10-year is an impossibility. I've never experienced before, unless it's either coincidental, which I think it is, or it is predicting that the Fed is taking some major action. There's been a major strategic sea change at the Fed.
Well, most of us,
I just don't see anything that you can say definitively. Looking at the Fed's actions, not their comments or anything else, but their actions, that you can say there's been a definitive sea change in their actions. What am I missing?
Well,
did they stop buying?
Well, you see, that goes to my first graph I showed about the nature of a solvency event versus a monetary policy-induced business cycle. QE3, QE2 have nothing to do with the growth rate or unemployment or whatever. It is solely an accounting identity, if you will, to offset solvency issues in the banking system. Therefore, whether they taper, whether he goes out and buys $300 billion more, or whether he sells it all, is immaterial to where the Fed objective for short-term rates and long-term rates is going to be. What matters is what's going on with Fed funds, and also, more importantly, what the expectations are for Fed funds in the future.
Let's cycle this back to crude. Crude's something that we all experience at one level or another. It gets refined down to the gas we put in our cars. Economically speaking, the U.S. is either A, slowing down, or B, is the only economic engine of the planet, according to some headline writers. Evan, can you tell me what your thoughts are on where crude is going to be going now that, quite honestly, we're starting to hit a change in how people are viewing the global economy, irregardless of Fed action?
Did you just say irregardless?
Yeah, I just said that. Let it flow.
Sorry. Excuse me.
I think from the way oil's acting and the fact that it's continued to hold up here without any violent spikes down, if they could hold over 105 despite what's going on in the world, and it seems like China is bad, but it's not as bad. You got India that's still using oil. Everyone's still using oil. They're just maybe not using quite as much in the United States because we all have these nice hybrids and all this other bullshit. But the thing about it is, who knows if it's the Saudis over there playing with their futures accounts, running up the futures, because
that's every time the
oil gets up here, they always talk about, and there was a headline out there, they're investigating oil price manipulations. So I wouldn't doubt it if it gets up to 110, and we get the president coming out, start talking about strategic oil reserve, and then we see the price drop $10. But if we don't hear any of that, we could see a melt up like spring of 2008 into summer 2008 when we ran up to 147, and we had stocks literally, once we got to about 120, stocks were inverse equities. So oil going up, equities going down. And when the market started crashing, that was the only time that really broke, when oil fell from 140 down to $28 a barrel.
I remember watching 11 points in 10 seconds.
Yeah, it was insane.
I was sitting with my trader down in Beverly Hills, and he used to be a floor guy over in New York, and so at Bear, and so I was literally sitting next to him as we were placing other trades, and I was just visiting them at the time, and he gets this pop-up IM, and it just said, "Watch crude, 10 points, 10 seconds." He nudged me. We look over in lifetime. Bam! It hit, and he just looked at me and goes, "That guy can do it." And that's the only thing that was ever said. Someone had some fun that moment. I'll just leave it at that. Speaking of fun, where's the most action in the market for a trader like you?
Recently, it seems like it's really moved to the 10-year and the 30-year, which the volumes have picked up. The Nikkei, Japanese yen, and then of course the S&P minis. So overnight, the 10-year and the 30-year seems to be much more liquid, but the problem is it's real slippery, and you have people in there defending their levels, and if you're trying to flip back and forth like you used to be able to, you just get housed. They'll run it like 7 ticks away from you, and then you puke it, then it'll come back. So, crude though,
hide and
is
seek
probably
in the
where
futures
everyone's
market,
focusing.
All right, Jim, are you there?
Yo, I'm here.
All right. Going to you now. What are your thoughts on crude? Give me your run on it, both geopolitically, price action, thoughts.
I think you may be putting too much behind the geopolitical into a move in WTI with no corresponding move in Brent. Since you're seeing the shortening of that gap, I think a lot of what you're seeing in the WTI contract is a 20 million barrel drawdown over the last 2 weeks in the supply at Cushing, which is pushing that price up. I think we're down to 373 million or something barrels, which is about, I'm looking at my sheet here, about 20 and change million barrels less in 2 weeks. That alone can move the price up the distance that we're seeing it change. If we're looking at for geopolitical, go back in history, you're looking at the Brent to WTI ratio increase rather than be so narrow as it is right now. I still think there's always the potential, especially with Egypt the way it is and other things in the Middle East, of them both going up. You could see 120. Right now, I think being in the WTI contract, the risk is to the upside. Still, even at 105 and change, even though I thought it was at 104 and change and was short there and got stopped out, I think you still have some upside risk in that. And I would be cautious before putting a lot of money long WTI without seeing more in the Brent contract and looking for that to change. You could potentially hedge that bet with a bet on the spread between Brent and WTI in terms of a long WTI position to help yourself out, but lower some risk. But I'd be very cautious in thinking that the geopolitical situation is going to raise the WTI contract without a significant raise in Brent or some indication in Brent that it's going to be equal. Then, of course, you're looking at the out months. You see in a backwardation still, it's only 100 in the December or October, November contracts. It's still well below where it is now in the August contract. So you have to be a little bit careful in attributing too much to geopolitical moves in WTI here.
Well, one of the things that's been happening with WTI is the opening up of the new pipelines and bringing that down and the backfill of them to the Houston market with the reversal of and the new build.
If we're seeing any increase in what's arriving at anywhere in Cushing or elsewhere in the States, you would think that would drive the price down, and the price obviously is going up. Again, I don't care how much you bring it in from Canada, a 20 million barrel drop in Cushing somewhere, there's a lot not coming.
Someone just bought something.
Has to be going on. I really am looking forward to see what happens Thursday in the next numbers. If it's another drawdown, you definitely could see the price shoot up, because that would be 3 weeks in a row after a 20 million barrel drop. If you see another even 3, 4, 5 million barrel drop, you could see a move up through 110 very rapidly, and it would have nothing to do with the Brent contract or anything else. It would just be a shocking move up. It was 3 weeks. It's I think the biggest drop since 1982 in 2 weeks, something like that, in terms of volume, in terms of what's coming into Cushing.
All right, Evan. Any thoughts besides the obvious issues at your end from the locals?
Yeah. I don't know what's going on there.
No worries on that. What do you think about the crude responses of Jim? And I'm talking about crude oil, not crude.
Yeah, no, I'm with him in regards to the geopolitical. That we could argue there's been a geopolitical catalyst in crude for the past 4-5 years, and crude has pretty much stayed over 85 for the greater part of a couple years. And a wise man told me, who has a lot to do with Middle East, he's like, everyone's happy in the Middle East as long as the price is over 85 a barrel. Sure enough, it stayed up over there. But like Jim said, the drawdown was huge, and it was unexpected, and that's kind of why that price seemed to react the way it did quietly the price was driven up, and it was fundamental demand. People are filling up. I filled up today. I'm sure a lot of people are driving. So
Agreed.
the fundamentals still can definitely drive it up. And if it stays over 105, especially over a 100 for a few more days, a week, that's just a solid foundation that it's building to where prices could just go up again. And it seems like people have accepted paying $3.75, $4 a gallon for gas. And in Chicago, I mean, if you put premium in, it's like $5.20 a gallon.
Really?
So there's really, I don't know.
I'm paying $3.99 in California, and I thought that was bad.
How much, Tim?
About $7.10 a gallon.
Wow.
For premium?
Yeah.
Not for regular.
Regular.
Where's that? Is that Alaska? Where is that?
No, I live in Grand Cayman.
Good gosh. Oh, okay.
You know what, though? It's an imperial gallon.
Yeah.
So it's probably, I think that amounts to about $6.30 or so a U.S. dollar per U.S. gallon. But it's still $3.75 sounds good.
Yeah.
I have just a question: is how do you explain the demand supply applied to oil when we've all seen the graph that I'm showing right now? I just don't get it.
It's hard to see the graph you're showing. And
well, it's basically the fact that we have record crude oil stocks right now. Not just sort of large. We have our lifetime record of crude oil stocks hanging around. Cushing they can't put oil anyplace in Cushing. Every oil pipeline is not, hardly. They can't. That drawdown was nothing. That drawdown just takes us down to maybe on the top decile of the 5-year highs. All pipelines are running slow now because I'm sorry.
It's still nearly 2%. It's still 20 million barrels. That's a decent.
That's nothing. I'm sorry, that's nothing out of 370 million. That's
okay,
just nothing.
Hold on, guys. Two numbers. Hold on, George. Let's put a couple of data points in context. Cushing supply is how large?
No, it's what, 20%, 30%?
Correct. Cushing is how large?
Yeah.
So
that would be 60 million.
Correct, as I understand things. So the actual draw was massive from Cushing. However, what's interesting is that it's still in the system. This oil hasn't disappeared. So more of who's drawing it. What refineries turned on that they needed that kind of volume. An example, and I'm going to go to your graph in a few seconds. Is here we'll do it now. Perfect.
We got a new one up.
Got it up. Major North American oil pipelines. The Saudis have spent a significant amount of money building. I believe it's the largest refinery in America with the upgrade, and they turned it on and they had a whoops, and they have not come back to what happened on that. But I think it was about 400,000 barrels a day of capacity was 380 or something. Have we ever heard whether they got that fixed? That was one of those that was going to be a 1 month fix, a 3 month fix, and I think we're about 6 to 9 months now.
I would look more at the trend to have refittings, all sorts of whoops, which always seem to magically happen at just the right time to jack gas and oil up maximum amounts of price. Well, it seems, from my point of view, it all started with Katrina. And what I would offer is I don't know if we'll ever have the information, and I don't want to sound grassy knoll on this, but I think the answer happens to those who control these pipelines. Like just slowing a pipeline down by a third of its normal transmission rate can have more of an impact on the demand supply of oil than a drawdown of stock, of inventory.
EP got their hands spanked hard.
Why would anybody do that?
Jim, hold on a second. Hold on, Jim. I'm stepping in on this
some
one.
Rich dudes in Texas for a while.
Jim,
and I was a fixing guy. I spent a hell of a lot of time trying to figure out the Houston Ship Channel versus Cushing spread. And I worked on it, and I did all this demand supply stuff and like GDP, Texas regional, all sorts of stuff. And I came to a guy and I said, look, I've done this work. What do you think of it, Jim Bob? And Jim Bob's answer to me was, he laughed. And he says, oh, we know that spread. All we do is we're all set to do it. 4 or 5 of us get on it, and we just reverse the pipeline flow. And then, boom, we get our reaction, and then we take our profit and we put it back on. I think that's got more to do with oil price than what people think.
I'm going to make one comment because it's very Googleable and provable. There's a natural gas pipeline that had to pay a bit of a price because they were constricting the flow of natural gas into Los Angeles. And in doing so, we're able to decide what the price points were for the power plants that were consuming that gas, right? And so I'm going to make up a number. It's a 1 BCF pipe, and it was magical how much was actually available in that pipe at any given time. And I believe they ended up paying a largest fine in pipeline history on that event. I'm going to go pull the data on it, and I'll bring that up and prove whether I'm right or wrong on the next episode.
Okay.
I want to transition now to our final guest of the evening. We have our Inside the Beltway guy, the one, the only, the hammer himself. You're on. What's happening in the MBS land that you cannot speak about?
Oh, lots.
Yeah,
there's a lot of things I can't speak about, so we'll leave it at that. I mean, you are starting to see in the credit products continued widening. It really hasn't changed much since last week. There were rumors of a roughly $2 billion Buick list.
Hold on, you're breaking up on us. Can you please repeat that? You just broke up a little.
Okay, I'm sorry. I'm having a little bit of a delay on my side. There was a rumor of a $2 billion bid list that went out, and it seems that while some of the capital markets guys, some of the sell side bought some of it, they haven't had a great ability to move it in mass. Even though
are you saying someone has inventory?
Yeah, there's from what I'm hearing, and of course this is from secondary sources. I'm hearing that some of these guys, especially some of the larger European banks, who've been bankrolling a lot of the hedge funds' leverage for these products, for these credit products, decided to bring some in-house. Sort of they're believing their own propaganda, and they're finding that it's being harder to move and spreads are starting to widen out. I'm trying to nail down exactly what's traded where and what type of vintages and so forth, but with not having screens like I used to, it's a little bit difficult.
Is that a case where the U.S. government no longer invests in U.S. government employees having access to Bloomberg terminals? Is that a subtle comment there? We in the government believe in being as effective as possible. I know that some of our other guests on the show may not believe this, but we really do go out of our way to try not to waste money. At least, my agency, and so we typically have one Bloomberg terminal every 3 or 4 floors. There are a few people that do have Bloomberg terminals, but not many. All right. So what is the most important aspect of the U.S. economy that you are seeing from your spot?
Wow. I think one of the things that I'm hearing a lot of, especially given my role, is for a lot of the MBS stuff or the private label stuff, anything outside of Fannie and Freddie, it's when will the government get around to finishing the Dodd-Frank rules, especially risk retention?
Isn't that one on your desk?
I can neither confirm nor deny that. Remember I said
just
there was
being a smart ass. The short answer is they have a point. The capital markets will arbitrage any rule that comes out. They know that. They've done it for years. They'll do it in the future.
But at this point, people are still waiting. What are the final rules? I mean, you are seeing some non-agency stuff get out, although the most recent stuff at slightly wider spreads. But the type of loans that are getting securitized outside of Fannie and Freddie are those that are very high net worth borrowers, very little leverage typically, and people who can really afford even bigger mortgages, or even in some cases just buy the house outright. I mean, when you take a look at a deal and you're seeing a weighted average income of, we're seeing an average income of 800 or 900,000. That's not your typical mom and pop type of mortgage.
No,
I mean, maybe for this group, but not for the typical American.
Not historically speaking.
Yeah, exactly. But I think one of the things I think for a lot of people, and this goes for CFTC, for for the rules for CFTC, CFPB, SEC, OCC, the FDIC, is people just want clarity. Once we know what the new, what people are telling me is, once we have the playing field laid out, the rules laid out, are we playing cricket? Or are we playing baseball, or are we playing some other game that has yet to be invented? So so it's just, that's where
stability of rules.
Yeah, it's just the stability. I think people have finally started getting smarter and started realizing, especially capital markets, that the government has a role, given the most recent blow up in the current laws on the books, and they have to understand that this is the way it's going to be for a while, and they have to adjust to that. And they can bemoan about this, that, or the other thing, but these are the rules. This is the rules of the road right now. This is what needs to get done, and people have to just face it and work with it.
All right, thank you, sir. Bob?
Yes, sir.
All right, I'm transitioning to you. We're gonna do now our final thought of the episode. You've got 1 to 2, 3 minutes. I'm setting you up because you're on camera and it's just more fun this way. The rest of them get to think about it in private and be off camera. What is the most important thing in the next week that you're going to be looking for in the markets?
Well, from my standpoint, I think it's really political turmoil. I think it's political turmoil in the Middle East. I don't know if anybody saw it today, but I do my general rundown of every damn news show. And on Face the Nation, Bibi Netanyahu was on, and was raising the cattle call on Iraq again. Or I'm sorry, Iran. Pardon me. So I think that's fairly interesting in light of Syria, in light of Egypt. I think Middle East turmoil is certainly not going to go away.
All right. So you're watching Egypt and the implications and ramifications of the neighbors around them and what they do.
Indeed.
All right. Thank you. Evan, thank you for joining us for the first time. I know you haven't had much airtime with us yet, but each episode is slightly different. I want to go to you now and ask you, what is the most important thing you're watching this week?
This week, watching to see if Treasury prices hold a floor here and perhaps meander up a little bit, waiting to see what the Fed jabbers off again, as if they might talk about more.
Hold on. You've been muted, unfortunately.
Whoops.
There we are.
Is it working now?
Yeah, now it's working. Please continue.
I think the biggest thing is going to be if the mortgages, or not the mortgage, excuse me, fixed income holds these the lows put in last week. See if they meander up a little bit. See if the Fed chatters again to try to get the yields down. They're day trading the yields, it seems like, at the Fed. But oil, maybe we'll see 110 if this keeps up, especially with this crazy heat wave that's supposedly coming. Going to be like 100 all through the Midwest. I'll be curious to see what goes on with nat gas and injection season and whatnot. But definitely focus on the bonds.
All right. Jim, what are you looking for in the next week? And I'm not talking about fish.
Give me. I want to see what the oil numbers are on Thursday for sure. I want to see. I think more important Fed speak than Mideast turmoil. I think our bar for Mideast turmoil moving the market is so high that it has to be something really major. It has to be Iran putting ships in the Straits of Hormuz rather than just more
All right.
turmoil
Hold
in
on.
Egypt. Something special has to
I
happen.
need to step on you right there for one moment, and then I'm going to come right back to you on that. Did you notice that both Russia and China have sent their fleets through a strait near Japan for the first time ever, and the Japanese are blinking?
I did not. You know what? I may not have seen that in the news cycle, so I can't comment.
All right. I'll send you a link to it
Anytime the
afterwards.
Chinese and the Russians move anything near Japan, you always have to kind of, do a double take. I don't know whether or not that will affect the markets that I follow so strongly, but of course, if there's any indication of hostilities, it always affects the oil markets more than basically just about anything else.
All right. George.
I think the only thing that matters now is to understand that huge divergence between risky assets and risk-free assets, and what exactly are the parameters that the Fed is now working under versus what they were working on under 6 months ago. And I think the best insight I'll get is from the initial claims number, which was really leading the way and giving you all the insights you needed to figure out what the Fed was doing, but has disappeared into a fog bank, if you will, for the last 3 weeks. So that's what I'll be doing.
All right. Thank you. And the hammer. The man. Nope. You're muted. Let's got to figure out how to unmute. There you are. What? No, I just muted you. Sorry. There you go, sir.
Okay. Well, I think what's on my plate this week is to really understand Basel III and its cross implications with both regulations that's currently in the books as well as other regulations which I may or may not be working on. So I mean, for me, unfortunately, in my role, I don't get to play the markets as much. I get to take a look at the infrastructure more. So that's kind of where I am, and I'm hoping by the next time we talk, I'll be able to give a better breakdown of what I see in Basel III and what may or may not be problematic.
Very good. I look forward to the Basel III conversation. On behalf
of... It's only 900 pages. It should take me only a couple hours to read.
Well, at least you're not writing it this time. Sorry.
Oh, God. It's shorter than the Dodd-Frank Act.
On behalf of my crew of guests here on the Macro Contrarian Roundtable Hour, Macro Tourists as we call ourselves at times, I want to thank everyone for watching us and joining us. My name's Jack Barnes, and we will be back next week, same time, same location, with some of the same guests and some new guests, or not. And I want to thank all of you for having joined us, and we will be back next week. Stay safe out there.
Thank you. Thank you all.
Thank you.